If you're thinking about using your home's equity to finance a project, consolidate debt, or invest, you have two primary options: a HELOC or a home equity loan. But which one is right for you? In this video, we'll break down the key differences, the pros and cons, and help you decide which is the best choice for your situation. Let's get started. A HELOC, or home equity line of credit, works similar to a credit card, except that the loan is secured by your home's value. You get access to a credit line that you can borrow from as needed. It's a temporary revolving credit account, so for a time, you can borrow, pay down the balance, and borrow again up to your spending limit. For a time, and depending on your HELOC structure, you can make interest-only payments for the first several years. However, unlike a credit card, you can only pull money out for the first part of the loan. A HELOC has two phases: a draw period, which typically lasts between 5 and 15 years, where you can borrow against your limit and make interest-only payments, and a repayment period of 10 to 20 years, where you can pay back the principal and the interest. You can no longer borrow additional money during the repayment period. Most HELOCs have variable interest rates, meaning your payments can fluctuate. However, some lenders offer fixed-rate options for budgeting stability. Distinguishing HELOC characteristics include these features. You can borrow as needed up to your limit. They have lower interest rates than credit cards, and they provide flexibility for future expenses. However, your payments will increase as you borrow more, and your variable rates can be unpredictable. A home equity loan, often called a second mortgage, gives you a lump sum of money up front with a fixed interest rate and monthly payments. Unlike a HELOC, you can't borrow more after taking the loan. It's a one-time deal. Additionally, you'll begin paying back the loan immediately in full and equal payments for the duration of the loan term. Because payments start immediately and include both principal and interest, a home equity loan can save money over time compared to a HELOC, which allows interest-only payments at first. This comparison chart shows the differences between the two options. Let's compare the pros and cons of each option to help you decide. HELOC pros include flexibility. You can borrow as much or as little as needed. Lower interest rates than personal loans or credit cards. And they're useful for ongoing expenses like home renovations. While HELOC cons are that monthly payments can increase as you borrow more, and the variable interest rates can make budgeting unpredictable. Additionally, it can be tempting to overspend when using a HELOC. Home equity loan pros include fixed rates that make budgeting easy, and having a full repayment schedule prevents overspending. You can also save money over time compared to a HELOC. However, the cons of home equity loans include that no additional borrowing is available after taking the loan, and your full payments start immediately. So, which is best for you? Well, if you need ongoing access to funds and aren't sure how much you'll spend, a HELOC offers more flexibility. But if you know exactly how much you need and prefer predictable payments, a home equity loan is the way to go. Before applying for either option, you'll typically need a few things. One, you'll need at least 20% equity in your home. You'll need a credit score of 620 or above, and you'll need a debt-to-income ratio below 44%. So, HELOC or home equity loan? Regardless of which you choose, you'll have many lender options, so make sure to shop around for the best interest rates and terms before diving in.